Okay, guys. So now let's look at class example number 6. So last week there was a request to say we looked at the different, we looked at the interest exemptions, and also like you would have noticed when we looked earlier at the tax tables, it said for the interest exemptions in terms of um, section 10(1)(I), in certain cases, so in instances of the year of your birth, if you any interest accrued to you in the year of your death, or in the year where you cease to be a resident of South Africa, that interest exemption is apportioned based on days. And class example 6 speaks to that. So in this case here, they, let's look at the required first. What does the required say? The required says, required number 1 says, discuss the tax implications of the interest earned by Mrs. X as a resident of the Republic and calculate her income for that period during the 2025 year of assessment. Requirement number 2 says, discuss the tax implications of the interest earned by Mrs. X as a non-resident and calculate her income for that period during the 2025 year of assessment. Okay, so let's now go back to the scenario. What does the scenario say? Mrs. X, a taxpayer in South Africa, becomes non-resident on the 15th of May because she moved to France. Again, the rulings about when you break residency will be dealt with in a later section. But for now, we are assuming that on the date that she leaves, that's when she becomes non-resident. So in terms of the legislation, just what the legislation says is if you started residency in another year, you are deemed to have ceased on one day. You are deemed to have ceased residence in South Africa on the day before. So in this case here, she was resident in South Africa until the 14th of May, and from the 15th of May, she becomes non-resident. Prior to that date, she was physically present in South Africa on a continuous basis. Mrs. X is over 65 years of age. Her only income is interest on an investment in a South African bank. She earns interest of 10,000 Rand per month, payable on the first day of every month, regardless of the number of days in a month. So here, there's two things we're looking at. We're looking at what happens in terms of required A, what was the implications for when she was resident, and what were the implications for when she ceased resident. Um, it's remember, and this is interest that's from a South African source. So interest from a South African source for a resident is that resident is subject to. Remember, the interest for a resident is taxed in South Africa on their worldwide income. A non-resident is taxed in South Africa on their South African sourced income. The fact that this interest is from a South African bank account means it's South African source. So for the period when she's non-resident, that when she's resident, she's subject to tax in South Africa on the interest earned, as well as when she becomes non-resident. Let's look at now the sections. So the first one is, again, we spoke about that. So there's the period when she was resident of the Republic is 75 days, but the period as she's non-resident from 15th of May to the 28th of February is 290 days. This should in total give you 365 days. So what would happen? Yes, there is a limitation on the rebates for non-residents. We'll chat about that. Well, rebates or the interest exemption. Speaking about the interest exemption, and I'll get to that just now once we deal on with number 2. So in this case here for number 1, we're still looking at the resident while she is resident. So for the 3 months, she will receive 30,000 Rand as gross income. So the 3 months multiplied by 10,000. When you put this in your spreadsheet, right? Instead of showing a calculation like I've shown it here, for this year I've shown it just for you guys for completeness purposes. So for example, what you do is you will go into the cell and you will say is equals to 10,000 multiplied by 3, and it will give you the answer. Okay? Then, in terms of section 10(1)(I), and she's over 65, so she is entitled to an exemption of 34,500. But because she ceased to be a resident in the current year, that 4,500 must be apportioned for the portion that she is resident in South Africa. So we'll say multiplied by 75 divided by 365, which gives us an amount. And again, remember, it's important to show this as a negative. So in this cell here, what you would say is equals to 34,500 multiplied by 75 divided by 365, and it will automatically give you the answer. Once you've set up your spreadsheet in the beginning to show negatives in a certain way, it will automatically show that way. Okay, and then your gross income minus your exemption will give you income of 22,911. So far, is everyone following? Are there any questions so far? Okay. Now, in terms of number two now asks us to show what are the tax implications for the interest earned while she is a non-resident. So it's this second period here from the 15th of May to the 28th of February, which is 290 days, where she's a non-resident of the Republic. How will we show it? Remember, non-residents have a special exemption in terms of section 10(1)(H). So non-residents have an exemption if they meet certain criteria, the interest, and there's no limitation on that, so it's the full interest earned, will be exempt from income under section 10(1)(H). If the interest doesn't qualify for section 10(1)(H), then they could also qualify for section 10(1)(I). Okay, so let's look at this now, break it down and look at it practically. So we say now,
we need to code section when we answer questions.
no, you don't. So you don't need to quote. Yeah, sorry, go ahead.
No, you can continue, ma'am. I was writing on a chat, so you respond.
Okay.
Thank you.
Sorry, my PowerPoint just seems to have closed. You don't necessarily have to quote the sections. What will happen? So when you're dealing with exemptions, right? And let's go back to this question here again. If we go to class question 6, in the first one. In this case here, your gross income and your exempt income are two separate amounts, right? So you don't necessarily have to say the section 10(1)(I) exemption. You can just say local interest exemption or interest exemption. And then as long as we can see that, we can follow that, you know it, it's fine. So you don't need to actually quote the section. I've put it in here just so that it's easier for you guys when you're starting to see, okay, where is this coming from, that you can trace it back to the actual legislation. Then another thing that's important to note in terms of exempt technique, in this case here, your gross income and your exempt income amount are not the same. So you have to show the calculation to say this is the amount of gross income, this is the amount of exempt income, or you don't even have to actually say gross income. You just have to say interest income, local, so that we can see that it's South African interest income, that you differentiate in between South African interest income and foreign interest income. That will also be sufficient. Okay. And then you calculate in income. If, however, these two amounts were equal to one another, so the full amount was exempt, and you showed in the exam to say interest income and you said exempt and you showed 0, you would also get the mark. the net effect. So if the net effect is 0 and you don't actually have to show 30 minus 30 to give you 0, you just have to show the 0 as a net effect and you will get your mark. That we can see, but you must put it in so that we know that you know. Okay, to come back to this, now we're back to the second part, right? So we said that from the 15th of May, Mrs. X received interest from a South African source as a non-resident. Now, non-residents for interest, there's two provisions that could apply. So first, you start by applying the provisions of Section 101H. So you're going to look at what um, are the provisions and how would a person qualify for Section 101H, and if it meets those requirements, you exempt it in terms of Section 101H. If, however, it does not qualify for the Section 101H exemption, then the provisions of Section 101I may apply. And again, remember, this year is for natural persons. So it's not applicable to companies, it's applicable to normal individuals. So what are the provisions of Section 101H? Section 101H exemption does not apply to interest received or accrued to a person who was physically present in South Africa for an aggregate period exceeding 183 days during the 12-month period preceding the date on which the interest is received or accrued. So what that means is on the date that that interest is either received or accrued to that taxpayer. If the taxpayer was present in South Africa for a period exceeding 183 days for 12-month period before, and here be very careful that this 12-month period is not the year of assessment, it's any 12-month period, right? If that person was physically present in South Africa, then Section 101H won't apply. And if we go back to the scenario here, it says here that she moved to France on the 15th of May. Prior to that date, she was physically present in South Africa on a continuous basis, right? So that would mean that for the first 6 months after leave, because 183 days is essentially 6 months of the year, okay? For the first 6 months after leaving South Africa, her interest income cannot be exempt in terms of Section 101H because she was physically present in for a period exceeding 183 days during that 12-month period. So the 10,000 multiplied by that 6 months will be 60,000. That's not exempt in terms of Section 101H. So this 60,000 could be now brought into the net for Section 101I. But let's take it before we get there. Let's look at the rest of the period. So we're saying from the 1st of November, now let's look back, right? So in order to determine whether she was present in South Africa for the interest that accrued to her on the 1st of November, we need to look at the 12-month period preceding that, which would be the 1st of November 2023 to the 31st of October 2024. And if we calculate that period, Mrs. X was present in South Africa for 196 days. So that means that up to the 1st of November, any interest that she earned will not be exempt in terms of Section 101H, but may qualify for exemption in terms of Section 101I, right? Then we look at the next month. From the 1st of December, so again, we look at what is 12-month period preceding the 1st of December. So you look at the period between the 1st of December 2023 and the 31st of November 2024. And in that time, Mrs. X was present in South Africa for 166 days. 166 days is not a period exceeding 183 days. Therefore, from 1 December, sorry, that shouldn't be up to, from 1 December, her interest is exempt in terms of Section 101H. Are you guys following? Any questions so far? Yes, Onati.
Good evening. I just wanted to find out as to why we using 1st November
Oh,
and not
okay,
looking at exactly the period starting from May. Is there
okay,
a reason why? And secondly, the other one, why we looking at December? I think I'm lost around that portion only.
okay. I'll answer your question now. Tandika, your question?
Yes, thank you, ma'am. I'm just want to double check the 166 days. Is it just what is given in terms of, because if you look at the 1st of December to November, that's the full 360 some odd days.
Mm.
Or is it just specific that she was traveling in between these two countries, therefore only 166 days she was in South Africa? I'm just trying to get that correct.
Okay,
Thanks.
okay, okay, cool. So let's take it back, right? Remember, she was in South Africa on a continuous basis until the 14th of May 2024, right? She only left the country on the 15th of May 2024. To answer the first question on why do we start with the 1st of November? So remember, so she would have been paid. So here it says she earns the interest of 10,000 payable on the first day of every month. In terms of the gross income definition, an amount is included in gross income at the earlier of receipt or accrual. What's the day of receipt for interest? It's the first day of every month, right? So she would have received a payment on the 1st of May. At that point, she was a resident, and then the next payment would have been on the 1st of June, right? So, how do we get to start looking at November? If we look at May, remember this 183 days, like I said to you, is 6 months. June, July, August, September, October, right? Starts, and then half of May is almost 6 months. That's where we start looking at from the 1st of November. We're calculating now where is roughly 6 months. Okay. Um, so we're saying half of May, half of the whole of April, May, June, July. No, so it's June, July, August, September, October, and half of May gives us 5.5 months, right? And if we calculate between the 1st of November 2023 and the 31st of October, she was present in South Africa from the 1st of November to the 14th of May in that 12-month period. So we physically then need to go and count how many days are there between the 1st of November and the 15th on the 14th of May. And that gives us 196 days, right? And then if we take it to the next one to say, now let's look at the next month. If we go to the 1st of December, remember at 1 November, she was outside of the country for 5.5 months. And 1 December, she's now out of the country for 6.5 months. So if she's out of the country for 6.5 months, it means that and we then start counting, okay, what were the days that she was present in South Africa during that period? So between the 1st of December 2023 to the 31st of November, when was she present in South Africa? We know she was present in South Africa from the 1st of December 2023 to the 14th of May 2025. And if we count all of those days, it will give us 166 days. Guys, does it make sense now? Do you want me to repeat it again?
I'm
I'm
fine.
lost.
Okay,
I'm
let's
lost.
do it this way. I'm going to open Excel. Let's do it this way, right? Just to, okay. So we know, so remember the start of, can you see my Excel?
Yes.
Yes.
Okay.
Yes.
So the start
Yes.
of the year of assessment is the 1st of March 2024, right? And the end of the year of assessment for 2025 will be the 28th of February 2025, right? Now, she left SA or she ceased to be a resident on the 14th of May 2025. Okay? Um, yes, Veron, I see your hand is up just before I continue.
No, sorry. That was a
Okay.
mistake. Apologies.
Okay, cool. No problem. So she left SA on the 14th of May. This is when she's so from the so before this year, up until the 14th of May, she was physically present in SA. Okay, so she was here in South Africa. Before this time, she never left South Africa. She stayed in South Africa. She then moved to France on the 15th of May. Not 2025, sorry, 2024. It should be 2024. Okay. Happy with this so far, guys. Okay, so this is
Yes.
it. So what we're saying is until this date, she was resident, right? And this was the date that she moved to France. So this was the date when she became non-resident. Okay. Residents qualify for the section 10.1I exemption, and non-residents, and this is on interest again, can qualify for the section 10.1H exemption, right? So for the first part, we've dealt with section 10.1I. We know we're happy with the resident portion. Can you guys still see my screen?
Yes.
Okay, cool.
Yes, we can.
Okay. Then it's now this non-resident portion. So when is the portion she's non-resident? It's from the 15th of May 2025 to the 28th of February 2025. So sorry, this 15th of May 2024 for purposes of this financial year, of this year of assessment. So for the 2025 year of assessment, this is when she's non-resident. So as a non-resident, it's preferable to first look to the Section 10.1H exemption because there's no limitation on that exemption. Whereas the Section 10.1I exemption has the limitation on how much of interest can be exempt. Okay, so we now need to look at, in terms of Section 10.1H, Section 10.1H says that one of the provisos is that you need to, if you were physically present in SA for a period of greater than 183 days during a 12-month period from the date interest is earned or interest is received or accrued, you will not qualify for the exemption. Okay? So if you were physically present in South Africa for a period exceeding 183 days during the 12-month period from which the date was interest, to which the date the interest is received or accrued, you won't qualify for the Section 10.1H exemption. So we now need to look at what is the days calculation. Okay. Now, we know that she left on the 15th of May. Remember, she receives or the interest is received or accrued to her on the 1st of every month. So she would have received interest on the 1st of May 2024 of 10,000. Okay, guys, this is not how you should present your answer in the question. It looks very untidy, just for purposes of this, but follow me, okay? Then 1 June 2024, she's going to receive the 10,000 again, and so forth, right? Until the end of the financial year, until the end of Feb, right? So now what we know, if you look at this 183 days, it's roughly 6 months of the year. So we know that when she left on the 15th of May, she was in South Africa for 6 months. So here we know she left on the 15th of May. So for the 15th of May 2024, she was present in SA for 14 days, right? Then she was not present, and then she was outside of SA for the remainder of the month, right? And then all this, and then after this year, she was outside of SA for the full months. Now we need to say, okay, she received this amount of 10,000 on the 1st of June. If she received this amount of 10,000 on the 1st of June, we need to backtrack to say, okay, now in terms of the previous periods, when was she in SA? So we have up until the 15th of May, she was there for 14 days. Then if we go back to April, so we look at April 2024, she was present, April 2024, she was present for the full month. She was here in South Africa for 30 days. For March 2024, she was present in South Africa for 31 days. Then Feb 2024, she was here for 28 days. January 2024, she was here for 31 days. December 2024, she was here for 31 days. And because remember, we're looking backwards from a 12-month period, right?
Sorry,
So,
ma'am.
yes.
Feb, was it not 29 days?
Okay, so it was
2024.
29 days. Sorry, my bad.
All right.
Okay. So now, when we're looking at the payment that she will receive on the 1st of June, we need to look at what was the period 12 months preceding that, and was she present in South Africa for a period of more than 183 days. So for June, it would have been 1 June 2023 to 31 May 2024. We need to calculate between this period how many days was she present in South Africa. And in this case here, because remember, she would have only not been here for the 16 days in Feb. So she would have been present in South Africa for 365 minus 16 days. So if that's the case here, that means that she was physically present for a period exceeding 183 days. So the amount for June can't qualify for the exemption. For July, we're going to do the same thing now to say, okay, from what was the 12-month period preceding the 1st of July? So 1 July 2023 to 30 June 2024. How many days was she present in South Africa? And that should give us 349 minus 30 or 31 minus 30. So she would have been present in South Africa for 319 days. So we're going to continue to do this. Is it starting to make sense? We're going to continue to do this.
Just a
Yes.
little.
Just still not. Okay. But so far the logic makes sense, right? You
Yeah,
understand
yes,
what
it
we're doing
does.
here. Okay, cool.
Yeah.
So again, from the 1st of August, you're going to do the same thing. You're going to say, how long was she present in South Africa from the 1st of August 2023 to the 31st of July 2024. And then it's going to be is equals to this minus 30 days. She was present for 289 days. On the 1st of September, again, the same thing. For the 1st of September 2023 to the 31st of August 2024, how many days was she present in South Africa? The 289 minus 31 days, she was present for 258 days. Then for 1 October 2023 minus 30 September 2024, she was present in SA for 258 minus, is it 30 or 31 days now? I think
Is
it's
it not
31.
30?
Is it 30? Okay, thank you.
Let's see. Let me just cross check. October is 31. No, you are correct. 31.
Oh, 31. Okay. Okay. Then from 1 November, you're going to look through 1 November 2023 to the period of 31 October 2024, and then you're going to get to that minus 30 days. At that point, somewhere along the line, I might have made a mistake. She was present here for 197 days. Okay, somewhere I made a mistake. It should be 196 days. But that's why we started looking at November, because before that, in all of those cases, she was definitely present in South Africa for a period of more than 183 days. Now, if we go to the 1st of November, we look in 1st of December, we're looking through the period of 1 December to the 31st of November 2024. We're going to say is equals to 197 minus 31 days is giving us 166. So up until this portion, yeah, she was physically present in SA for a period greater than 183 days during the 12-month period from the date the interest was received or accrued. So for this red period, she's not going to qualify for the Section 10(1)(h) exemption, right? But from the 1st of December, she was not physically present in South Africa for more than 183 days. So therefore, she can now qualify for the Section 10(1). So here she will qualify now for the Section 10(1)(h) exemption. But before this, she didn't qualify. Yeah.
Okay, so ma'am, just to try to reinstill this thing in my head.
Yes.
The number of days that you are minusing as you move forward, is it a period between the start of the month and the end of the previous month, or it's the
Yes.
current month's days?
You're going to look at in that month. So between the 31st of May in year, how many, and between the 30, so year we know between the 31st of May and June, there was 30 days. So there it should be minus 30. July has 31 days, so there should be minus 31.
So it's the last month's days according to the period
Yes.
of 12 months that you then minus those. Okay. All right.
Yes. Yes. Does it make sense, guys? So for
Oh, very
these,
complicated.
this is one of the more complicated ones. There is another example that I've given you guys in the practice questions that is a bit more simplified. It's just because I wanted to explain the concepts to you guys. So this one I know is a difficult one, but go and work through it again in your own time. It's important for you to work through it and then look and just make sure that you understand. But I just need to make sure for my purposes that you guys know what you are required to do.
All right. Thanks.
I'm asking anyone else, is everyone with me following where we are? Now you know why I chose to have the break before we started this question. Okay, so in this case here, we are saying that now if we go forward, now her days are just going to get less and less, right? So for the periods of December, January, and February, the Section 101H exemption applies, right? But for the periods before that, so from mid May to November, the Section 101H exemption did not qualify. So for these months we did not qualify, we can then now look to see if the Section 101I exemption will apply. Okay. So in this case here, remember again, just to reiterate, for December, January, and February, the interest amounts of this 30,000 year will qualify for the Section 101H exemption. But in the months prior to that, so for these months here, where it did not qualify for the exemption, we then look to Section 101I. So let's go back to this. Okay, so we say now you can see why for the first 6 months we said it won't be exempt under Section 101H, and then up to November it won't be exempt for in terms of Section 101H, and we look at Section 101I. Then from 1 December it's exempt in terms of Section 101H. So let's look at the calculation now. So for that period that she was non-resident, she would have received gross income for 9 months. So it's 9 times 10,000, 90,000. Then there were those 3 months, December, January, and February, where she qualified for the Section 101H exemption, so minus the 50,000. Then for the other periods when she didn't qualify for the Section 101H exemption, we apply Section 101I, but remember, we need to apportion it for the days that she was non-resident. So here we would say 34,000 multiplied by 290 times 365 gives us that amount, and then the gross income minus your total exempt income gives you an income of 32,589. So it's just important, and this is just a note here to say that if, for example, she stopped receiving the interest income when she ceased residency, she only would have qualified for a portion of, she only would have qualified for this portion of the exemption. She only would have qualified for the 7,089 and not the full 34,000. In this case, because she continued to receive it, she would still qualify for the full 34,500, but that's how the split works. Any questions before we move on from this one? You have to go in, you have to get your hands dirty on it and take your calculators and calculate the actual number of days, even if it means you are using your fingers. Go for it, just so that you understand where the days are coming from. Okay, let's move on to, let's take a 4-minute break before we move on to the next question, just for everyone to just rest their back. So we'll start again at 1950, sorry. Okay, guys, let's continue. There are just 7, 8, 9, 10. So there's just 4 more questions that we need to work through. Okay. Class example number 7. Here again, the required is calculate Coney's income for the 2025 year of assessment. So Coney is a South African resident, aged 49. Coney received the following during the 2025 year of assessment. He received local interest of 1,000 and local dividends of 1,600 in respect of a local local collective investment scheme in securities. He also received local interest on a savings account of 23,000, net rentals from a flat inherited from his late father of 55,000. This net is deemed to be his trade, but we'll speak about that. It's basically saying his income less his deductions, and then local dividend income paid as part of an annuity of 60,000. Of 6,000, sorry. So we're going to start out by looking at what forms part of our income minus our exemptions to calculate our income. One of the things with ACCA is they are not very strict on the format. So what we say in terms of format, you should group all of your gross income amounts together minus your total exempt income. There are certain cases where making sure you follow format, especially for individuals, counts. But generally, for purposes of your ACCA exam, you can put them one under the other. You won't get penalized for that. Okay, so again, the solution will be presented in a spreadsheet, and you'll use formulas where applicable. So the first thing is your local interest of 1,000 will be added to your gross income, and then you will have local interest from a savings account of 23,000. That's included here. He is 49 years old, so therefore, as a resident, he is entitled to an exemption of 23,800 because he's under the age of 49. So minus your exempt income of 23,800, which will make his income on his interest 200. So here I've split it out into 3 columns, one column being your wording, the second column being calculations, and the third calculation being what is the total amounts that will contribute towards your income. Okay. Then the second thing we said was local dividends. So local dividends are included, so it's plus your 1,600. And then remember, local dividends are exempt from normal tax in terms of Section 10(1)(k), so minus your 1,600. 1,600 minus 1,600 is 0. So remember, I mentioned to you earlier, where the total amount is not fully exempt, you need to show your calculation. But in this case here, you didn't actually need to show that. As long as you just showed the 0 and showed that you knew that it was local dividends that were exempt, you will get your mark. But here, there would have been part marks for each of these amounts. So make sure you show that and not only show the 200. You could show the 200, but in case you get amounts wrong here, you will lose the full mark allocation. Therefore, you have to show these calculations, but in this case, it's good enough just to say the 0 there. Okay, then your net rental income will be plus the 55,000. This dividend income that you received will not qualify for an exemption in terms of Section 10(2)(b), because remember Section 10(2)(b) said that if any amount of dividends or interest are paid out as an annuity, there will be no dividend exemption. So you add the 6,000 and the total sum of your income is 61,200. Yes, Tandeka, you have a question?
Yes, ma'am, I'm just double checking the
Yes.
200.
Yes.
The 23,800 the exempt amount is bigger than the income that he received, but at the same time, we've got a positive amount on that end. How does it plays out?
Okay.
Or it
So
doesn't
here,
matter?
So here, what you're saying is your gross income of interest, your total gross income was the 23,000 plus the 1,000, which gives you total local interest income of 24,000. Minus the
Oh,
23,800 gives you the 200.
I didn't do the addition of the 1,000. No, it's okay.
Okay, cool. And again, another important thing, thank you for mentioning that. Another important thing to say, if, for example, we didn't have this 1,000 and the total interest income was 23,000, then your exemption would be limited to that amount. So it's never going to give you a negative amount. So if your total interest income, for example, was 23,000, then your exempt interest income will be 23,000. It's not going to give you a negative. It will be limited to 0 there. The same way like it was here, that it was limited to the amount that you received. Okay. Any questions on this one here? This one here is a pretty straightforward question. You could expect to see something like this as part of one of the constructed response questions, but you could also ask one of these as a multiple choice question in section A, where they'd give you the required, ask you to calculate the income, and then say, is it A, B, C, or D? And then you have to do the calculation and then put in the right amount. And that's why I said some of your questions for section A might take a little bit longer and others might be a little bit more straightforward to answer. So this could come in either section. And this typically is something that I have seen come into every paper. So this is definitely the type of question you can expect. Okay. Then class example 8. In this case here, let's look at the required again. The required says calculate the gross income of Fair and Wide for the 2025 financial period and calculate the income of Fair and Wide. So here, one is asking for gross income. The second one is asking for income. So then we know it's gross income minus your exempt income. What happened here? So Fair and Wide, Pty Limited, when we see Pty Limited, we're dealing with a company, a private company, right? Fair and Wide Pty Limited is a South African resident that invests in shares. Fair and Wide is not a share dealer, and all of the shares held are for investment purposes. So it's to say that why this is relevant is to say that they are not investing in shares as a share dealer, so the receipts from these shares would not be considered revenue in nature. It would be considered capital in nature. That's where that comes in. But remember again, then we're looking at the special inclusion provisions that then would say certain amounts, irrespective, would be included even if they are capital in nature. And also the other principle that comes out of this year is we're speaking about investments in shares, and then we're going to come just now, you can see to they earn dividends, they earn interest on these things. Brings us back to the concept of capital versus revenue and the tree and fruit case, where the investment in the shares is considered to be your capital investment, which is the tree, and the dividends and interest coming out of it is the fruit, which is considered revenue in nature. Okay, so the following information is provided for the year of assessment ending 31 December 2025. They received dividends from South African companies of 200,000, interest from South African bank account of 150,000, interest from a Swiss bank account of 85,000, distribution from a collective investment scheme, interest from there they received interest of 20,000, and dividends of 10,000. And then they received foreign dividends of 300,000, and the foreign dividends are from the following three companies. So this 300,000 is made up of these three amounts. One being from this UK company where Fair and Wide holds 25% of the total equity shares and voting rights, and Forico is not a controlled foreign company. So from them, they received 100,000 rand in dividends. From this Irish company, Fair and Wide holds 5% of the equity shares in this Irico. Irico is not a listed company. Fair and Wide will not include the proportionate share of their profits in the income in terms of Section 90 or CFC rules. Then Bigco, Fair and Wide owns 5% of the shares in Bigco. Bigco is listed on the JSE as well as London Stock Exchange, so it's a dual listed company, and it's not a dividend in specie of 150,000, which means if it's not a dividend in specie, it means they got the money in cash. So if we look here, this question is actually now dealing with a lot of sections. We're looking at South African dividends and foreign dividends. South African dividends, so both South African and foreign dividends are included in your gross income, but then they are exempt from gross income in terms of different sections. So your local dividend income is exempt under Section 10(1)(k), but foreign dividends are exempt under Section 10 Cap B. Then we have interest from a local interest and interest from a foreign bank account as well. And remember, it's important here when we're looking at Section 10(1)(I), it's not applicable here because this is interest, local interest paid to a company, not a natural person. Okay, so let's look at it. Let's first say calculate the gross income, and then we're going to calculate the income. So in terms of gross income, the dividends from the SA companies will be included in terms of paragraph K of the gross income definition, so that's 200,000. Your interest from your SA bank account will be included 150,000, and again, no interest exemption because the interest exemption is only applicable to natural persons. Foreign interest from the Swiss bank account of 85,000 is included in your gross income. Foreign interest, whether for companies or for natural persons, there is never an interest exemption. Then from the collective investment scheme, you earned interest and dividends of 20,000 and 10,000, also added to your gross income. Then what you received from your foreign dividends, which is that total amount of 300,000, also included in your gross income paragraph K, in terms of paragraph K to the definition of gross income, and your gross income gives you a total of 765,000 yen. Now, part B asks, or part 2 at least, asks you for your income. So now we're going to take this total gross income and now apply the exemptions to calculate the income. So if we look at it and we break it down step by step, right, we know that local dividend income is always fully exempt. So this will be exempt in terms of Section 10(1)(k)(1) minus your 10,000. Then your dividend from your local collective investment scheme, same. So you'll say minus 10,000 there, right? Then we said, remember, there's no exemptions on interest, right? So here we have, so none of these amounts, so this will be 255,000 of interest. There's no exemptions applicable to it here. Now we need to look at the dividends, right? And foreign dividends are exempt in terms of Section 10 Cap B. In terms of Section 10 Cap B, you first need to apply the provisions of Section 10 Cap B2. In terms of Section 10 Cap B2, it has specific rules to say if the dividend comes from these specific types of categories, then it will be fully exempt. If, however, the foreign dividend doesn't qualify for exemption in terms of Section 10 Cap B2, then we go to Section 10 Cap B3, which then is a partial exemption. So it only allows us to partially exempt a portion of those foreign dividends. So if we look at 10B2, the foreign dividend from, if we look at the first one here, the one from Foreco, why is it allowing me to go back? So this one here, the first one here from the UK-based company, remember there was the participation rights to say if you hold more than 10% of the equity shares, the dividend received from that is exempt. So this amount here is exempt, right? So we'll see there that's exempt. Then in terms of the one from Irico, it didn't qualify for any of the specific exemptions in terms of paragraph 10 cap B2. So therefore, we apply the partial exemption in terms of paragraph section 10 cap B3, which will say we take the amount of the dividend received, which was 50,000, and in this case we are dealing with a company, so multiply it by 7/27, and that will give you your exemption. Here again, just for purposes of exam technique, you didn't have to show this calculation. We could just say is equal to 50,000 multiplied by 7/27 to give you your answer. Then remember the 7/27 was included on that tax rates and allowances guide that you will get. It's just important to know when to use it. So in this case, because the foreign dividend was paid to a company, we use the 7/727. If it was paid to a natural person, you'd use the 25/45. And then in terms of BIGCO dividend was exempt in terms of section 10B2. And let's see, what was this dividend again in respect of? This one here is not a dividend in specie, so in cash, but in respect of a JSE listed share, and that's why it qualifies for that exemption there. And then you take the gross income minus the amount exempt to give you your total income. Guys, any questions on this one? Okay, move on. Last example, number 9. So Peter, in this case here, again, we're calculating Peter's income for the 2025 year of assessment. Here we're now starting to bring in a little bit more of an integrated type question, and some of the things and as we go along, we'll build more and more. So for now, this is a pretty basic one. It's not very detailed. Peter, who's a resident of the Republic, retired from his employment on the 31st of March 2024, having reached the age of 70. On the 31st of March, Peter had the following receipts and accruals. His final monthly salary of 39,600, accumulated leave pay of 29,700, a retirement bonus of 300,000. On 1 April 2024, Peter used 120,000 of his bonus to purchase an annuity of 18,000 Rand from an insurer. He will receive a payment of 4,500 Rand on the 1st of April and subsequent payments of 4,500 every quarter thereafter for life. On the 30th of April, Peter received his first monthly pension payment of 32,400. It continued to accrue to him on the last day of every month from then on. His life expectancy is 12.86 years, based on his age at the birthday preceding the commencement of the annuity contract. He received local dividends of 11,250 and didn't have any other receipts or accruals. So here we're going to calculate his income. So we'll add his salary of 39,600, the accumulated leave pay of 29,700, the retirement bonus of 300,000. Then in terms of his pension, remember, when did he start receiving the pension? He didn't receive the pension for the full month. He only started receiving the pension from the 1st of April when he retired. So 32,400 multiplied by 11 months. Then in terms of the annuity, he received 4,500 each quarter. So if you take 4,500 from the 1st of April, then what's each quarter? You'd say April, May, June, and then he'd receive again in July. And then again August, September, July, August, September, he'd receive again in October and then in January. So for the full year, he would have received 18,000. Then this is the inclusion in terms of paragraph A of the gross income. Because it was a purchased annuity, he will also qualify for the exemption of the capital portion of the purchased annuity in terms of Section 10 Cap A. So we calculate what was his purchase consideration. He paid 120,000 for the annuity, and what will he get over the lifetime of the contract? He will receive 18,000 multiplied by his 18,000 yen per annum multiplied by his lifetime, so for 12.86 years approximately, and then multiplied by 18,000, that what was the annuity he received in the current year. Then this will you'll say the gross income minus your exempt portion, and his inclusion into income will be this 8,668.74. In terms of the South African dividend, he received 11,250, and the full amount is exempt in terms of Section 10(1)(k). So his total income is 766,768.74. Any questions, guys? Okay. Then that brings us to the last question for today. We're saying again here, we're calculating Clint's income for the 2025 year of assessment. Clint is a resident of the Republic. He's 76 years old and he's a retired coal miner. He had the following receipts and accruals in the 2025 year of assessment. He received a monthly pension of 13,500 for past services rendered, a war pension of 750 rand per month, a salary from part-time employment of 9,000 rand per month for consultancy work he renders to Dundee Coal Limited for the 2025 year of assessment, local interest from a bank account of 42,700, and a gratuity of 9,000 was awarded to him by Dundee, who he renders services to, for successfully passing a mining examination at a qualifying university. To calculate this, so his monthly pension for past services rendered is he's included. He will receive 13,500, so that's 160 multiplied by the 12 months. It's 162,000. The war pension, in this case here, the war pension would be included, but then exempt in terms of Section 10(1)(g). So therefore, you can see in this case here, I just showed the zero. I didn't show the full calculation. You'll still get your full mark. Okay, then the salary for the consultancy work, so 9,000 multiplied by 12 gives you 108, which is included. And then the local interest, he received 42,700, but the exemption is limited to 34,500 because he's over the age of 65. And the total inclusion into his income is then the 42,700 minus the 34,500. So the inclusion is 8,200. And then the gratuity, even though it was paid to him as a reward for passing his examination, it wasn't exempt because it's the exemption under 10(1)(q) is not applicable to a gratuity. It's applicable to the bursary or the scholarship that you get. So therefore, it doesn't qualify for this exemption, and it's included in his taxable income, and the total of that gives him a total income of 287,200. Any questions, guys? Okay. So just in terms of your homework for today, all of these questions that we've done today in class, as well as there's a few other questions. So it's Unit 3 practice questions. It's under the Unit 3 folder, under the page called practice questions. There's question 1 to 14. So some of them are included. I think there's 6 additional questions that we haven't covered today that I've put up there. Please go and work through those questions. Make sure that you mark yourself on it. If you don't understand, go back into the content, see where you're going wrong, what you're not understanding. If you're struggling, please get in contact with us and let us help you now. And again, when you are practicing these questions, please make use of the practice platform. Are there any final questions before we close off the session? Yes, Dando.
So there's this item that you told, is it something about investment that you commenced with today?
The collective investment scheme, yes.
Collective investment scheme. So which, in those slides, is it in the slides for topic 3, unit 3?
Yes. So what I've done is I've added this collective investment scheme. You'll find it in I've added it to last week's slide deck, and it's in the slide deck that's for part B of the slides as well. So it's in both slide decks. Also, for last week's slide deck, please, if you've downloaded that slide deck, please download a new version of it, because I've updated it. I've added in a few things and updated a few things in there.
Okay.
Any other questions? Okay, Serge, I think you can stop the recording. I'm going to stop sharing. I'll stay on until 12:30 to answer questions. Yes, Leonard.